With the Federal Reserve considering lowering interest rates after a period of unprecedented hikes, uncertainty looms for investors. Meanwhile, the banking sector braces for significant chaos, hinting at major changes ahead for U.S. banks. Let's break it down. For the past couple of years, we've been in what's called a tightening cycle, which basically means the Fed has been steadily increasing interest rates. This is quite different from the low rates we had during the pandemic. The Federal Reserve really went all out to fight inflation, raising interest rates a whopping 525 basis points between March 2022 and July 2023. This was the fastest series of rate hikes we've seen in 40 years, even surpassing the rate hikes from 2004 to 2006. To put it into perspective, the last time we saw something like this was back in 1980 or 1981, when interest rates soared to nearly 20% as the government tried to tackle sky-high inflation. This tightening cycle came after a long period of quantitative easing, where the Fed pumped a ton of money into the economy to boost it. They ended up with over $4 trillion in assets, which is obviously a lot. The extended period of accommodative monetary policy before the shift towards tightening outpaces any previous cycle, both in terms of duration and scale. Now, as the Fed wraps up its spree of raising rates to fight inflation, they're hinting that they might start cutting rates this year. The folks on Wall Street are expecting the first rate cut to happen, possibly as soon as March. But here's the thing. Investor optimism is fading slowly. Despite the initial excitement in the market about inflation getting close to the Federal Reserve's 2% target in 2023, recent developments have made economists skeptical about the possibility of a rate cut in March. Fed Governor Christopher Waller, a prominent figure in the central bank, recently said in a speech that there's no rush to quickly lower interest rates. During a virtual discussion with the Brookings Institution, he explained, "When the time is right to start lowering rates, I believe it can and should be done methodically and carefully." Waller pointed out that the economy is doing well, with strong activity, job markets, and inflation gradually going down to 2%. He emphasized that hasty and fast rate cuts aren't on his agenda. Other Federal Reserve officials joined in, rejecting the idea of making rate cuts in March, calling it unrealistic. Cleveland Fed President Loretta Mester echoed the need for more evidence, referring to the latest consumer price index, which showed a slight increase in December. Mester insisted that addressing these concerns would require a careful and measured monetary policy. San Francisco Fed President Mary Daly agreed, cautioning against premature assumptions of an urgent need for policy changes. In a similar vein, Federal Reserve Bank of Chicago President Austin Goolsbee warned that financial markets might be getting ahead of policymakers in anticipating a series of rate cuts for the year. Goolsbee stressed the importance of making decisions based on actual data rather than speculative market trends. While these officials are urging caution, the data available points to significant challenges faced by banks, hinting at a potential crisis. Banks are dealing with problems stemming from problematic loans linked to commercial real estate. This is compounded by a recent surge in delinquent consumer debt, especially in credit cards and auto loans. In the past year, U.S. credit card debt skyrocketed to $1.08 trillion. According to data from the Federal Reserve Bank of New York, credit card balances increased by $154 billion since 2022, marking the most substantial increase in 25 years of the bank's data tracking. Analysts are worried about these escalations, especially considering that banks' reserves for potential losses are currently lower than they were at the start of the pandemic. Gerard Cassidy, a bank analyst at RBC Capital Markets, emphasized that while current bank reserves are considered okay, they might not be enough if there's a severe economic downturn. The challenges in the banking sector are expected to worsen. A staggering $1.5 trillion of U.S. commercial real estate debt is set for repayment before the end of 2025, raising questions about who will lend to these borrowers. Morgan Stanley analysts, including James Egan, have highlighted the significant risks of refinancing for property owners across different sectors, from office buildings to stores and warehouses. This adds to the concerns as the maturity wall approaches, making things more complicated. Small and regional banks, which were crucial in providing credit to the industry last year, are facing turbulence due to deposit outflows following the demise of Silicon Valley Bank. This raises concerns about their capacity to offer financial support to borrowers. The debt landscape is expected to deteriorate before showing signs of improvement, with maturities increasing over the next 4 years and peaking at $550 billion in 2027, according to Morgan Stanley. To make matters worse, banks hold more than half of agency commercial mortgage-backed securities, significantly increasing their exposure to the sector. This could raise the risk of defaults. Analysts highlight that the multifaceted role of banks in the financial ecosystem, having not only as lenders but also as buyers, will worsen the imminent wave of refinancing. However, stricter regulations are now being imposed on banks to prevent massive failures, similar to those witnessed last year. On July 27, 2023, the U.S. Federal Reserve and FDIC put out a notice for new rules called Basel III Endgame. This is basically a big set of rules that will change how banks calculate risky assets. These changes will have a big impact on how banks do business, making them rethink how they use their money. Potential impact includes globally systematically important banks experiencing an increase of 21% in capital requirements versus a 10% increase at regional banks. Implementation of Basel III Endgame would take effect July 1, 2025, with a 3-year phase-in of the capital ratio impact through June 30, 2028. Now here's the thing. Bankers are worried that having to keep more money in reserve might mean they won't be able to lend as much to regular folks and small businesses. Or, if they do lend, they might have to charge higher interest rates, which could make loans more expensive overall. These high reserve requirements make it much harder for regular people and small businesses to get loans or credit. This is dangerous because putting too many rules on U.S. banks could really hurt a specific group of people who depend on these banks, not just for business loans, but also for personal and farming loans. But there are some studies that say something different. One study actually suggests that making banks keep more money in reserve might not actually change how much they lend out by that much. Even if banks change their money management to make more profits, it probably won't stop people from borrowing or make them go to other lenders instead, the researcher says. Some even suggest that the money banks have set aside to cover losses is only a small part of their total money. Making them set aside more, like 10% to 15%, won't really change how much it costs for them to get money. And if banks lend less because they have to keep more money in reserve, the Federal Reserve could step in by lowering interest rates between banks. This could help boost the economy, even though banks are being stricter with lending. But hold on. There's a downside to all of this optimism. Right now, the banking industry is slashing jobs big time as they try to save money, and they're also being more careful about who they lend money to because more people are falling behind on their payments. And with stricter rules in place, these problems are only going to get worse. A big player in finance, Citigroup, is planning to cut about 10% of its workers worldwide to make things more efficient. This means around 20,000 people will lose their jobs by the end of 2026, out of Citigroup's current staff of 239,000 people worldwide. This news came out at the same time as Citigroup reported big losses of $1.8 billion in the last quarter of 2023, while CEO Jane Fraser thinks things will get better in 2024. CFO Mark Mason says that restructuring will be tough on everyone's spirits. So, it looks like everyone, from the banks to the regular folks, is in for a rough ride. Tougher regulations imposed on banks will automatically mean tougher regulations for Americans and businesses who need credit. And this is the worst time to put pressure on the struggling American consumer. The number of people falling behind on their loans has been going up since the pandemic. This is especially true for folks with credit cards, showing that even though the economy seems okay, many people are having money troubles. In the third quarter of last year, the number of people behind on their credit card payments went up by 21 basis points, reaching almost 3%. That's the highest it's been since early 2012, when we were still dealing with the aftermath of the financial crisis. At the same time, The total amount of credit card debt hit a record $1.2 trillion in 2023, with interest rates hitting a high of around 23%. And for folks with auto loans, the percentage of people behind on payments for more than 90 days hit 2.53%, the highest it's been in over 13 years. These are definitely warning signs, and things are likely to get worse. And speaking of auto loans, adding fire to this economic collapse is the fact that the biggest car market crash of our lifetime has just begun. Click the video on screen now to learn more.